It's Bitcoin, y'all. I'm your host, Zoom Out. I start a series of videos that are talking about some terms in cryptocurrency and Bitcoin that can be confusing, sometimes counterintuitive to what they actually mean. And so today I'm talking about the term trustless. You'll hear this term used when people talk about Bitcoin. They say it's trustless. What does that mean? First off, it's a good thing. That can seem counterintuitive. It sounds like trustless. That doesn't sound good, but it's actually a good thing. So let me explain why. Let's start with the traditional finance banking system. If you deposit money into a checking account, then you are trusting the humans that run that bank to keep your money safe. You're trusting them to have it if you ask for it to be returned to you, and you're trusting that it'll be there if you need to send it to a merchant to buy something. Now, the bank is taking that money and they're keeping some of it for that, but they are lending out some to other people and then charging an interest payment. So they're making money on the money that you put in the bank. And if you've got an interest-bearing checking account, they might return a little bit of that to you. If you have a savings account, they might return a little bit of that to you. Today, those rates of return are very low. You're real lucky to get something like 1%. Some credit unions might offer a little bit higher. You can get as low as 0.05%, maybe even lower. Now, when you say trustless, what that means is you can take the Bitcoin that you buy, you can store it digitally. It's always stored digitally, but you can custody it to yourself. I did a video about keeping your Bitcoin safe, what it means to custody to yourself in the past. So I'll put a link to that below. But a quick refresher is that you basically have a wallet that holds your password in it. Your money's on the blockchain. It's a verified transaction that's on an open recording. It's called a ledger, but it's an open. Anyone can see that it's recorded and published and verified. And then you have an either 12 or 24 word password that has to be put in a certain order to transfer that money anywhere, to do anything with it. So the only person that has to be trusted in this case is you. You have to trust yourself to keep up with the password. You have to trust yourself to not let other people have it. And then you have to trust yourself to use it when you want to use it. But you're not trusting anyone else, and that's what trustless means. Now, there are crypto banks that are making a business out of allowing you, instead of custodying it to yourself and using a 24-word password that you have to put in to send it, you can store it in a bank that is much more like a bank that you use today, but it's for cryptocurrency. And if you store it there, they're going to do the same thing. You're trusting them at that point to keep it safe. And they're going to do the same thing that banks in the traditional finance world do. They're going to loan it out, and they're going to get a percentage back on it. They might do other things with it that are investment vehicles that generate yield, that generate income on your money. But instead of in the traditional finance world, where there's no way, you can keep some cash at your house, but you don't want to have large amounts of cash at your house, right? This is a way that you can keep all of your cash digitally so that you can transact with it in digital means, meaning paying at the store or, and you just have to use your phone to do it, and that's coming. There will be more integration with that in the near future. You're going to be able to use that payment system in the future. But we're not quite there yet. There are some places online, but we're not quite there yet. But it's coming. So in the traditional, if you want that ability to use a debit card or a credit card, then if you put your money in to use a debit card, there's no way to basically be your own bank. With crypto, there is, which means the only reason you would put it in a bank, in a crypto bank, is because they're going to pay you more for it. So you can get 5%, 7%, sometimes 9% plus yield on your assets by storing them in there. But they're at a higher risk because they're not federally insured, FDIC insured. So if a bank does something bad with your money and the money's not there when you want it, the federal government, up to a certain amount, guarantees that you'll get your money back. I don't think it would be overnight. Something a lot of people don't realize. It'd probably take longer than you think it would, but they would eventually get your money back to you. They've made that guarantee. Whereas cryptocurrencies are not federally insured, so you would want to do your research and be like, okay, these guys have got a large amount of cash on their investment. They seem to be a thriving bank, a thriving business, and I feel safe putting it over there to get 5% yield back. And I'm willing to take that risk on this piece of money because I'm going to be getting that return. So it just allows the possibility for more competitive, because you can choose to keep it yourself and not trust anyone. Well, if you're going to trust someone, they're going to have to pay you more. And banks are making a killing off of this, off of your money, off of my money. They should be paying us more. And this offers competition to that. Hey, if you enjoyed this video, hit the like button. If you want to hear more, hit subscribe. Nothing I've said today is financial advice. If you want to buy crypto or Bitcoin, do your own research. Hope that you understand a little better of what the word trustless means. And if there's anything I said that wasn't quite clear, leave a comment below and I'll clarify it. Thank you for listening today. And yeah, I'll be back.